Hey everybody, today I want to talk about how to shop for a mortgage. You know, this is one of the biggest financial decisions you'll make in your life, and so it's really important that you not only find a good deal, but you kind of understand how you got there. You know, you understand the process. And the very first thing I'm going to tell you is find somebody you trust. Work with a local mortgage broker. You'll find competitive pricing. You may find slightly better by getting on the phone and going to bankrate.com, but you'll end up with a call center in the Midwest for someone who is completely unknown to you, who you'll have no personal interaction with, you won't be able to meet face to face with, and there'll be just very low level of accountability there. Find somebody you trust. Find somebody you can get in front of and that you can get a real good sense of, because that's super important. This is a very highly regulated industry, and when you get things that are highly regulated, they become highly complex. Even though the underlying fundamentals aren't necessarily that complex, with all the disclosures and things that go on, it's easy to get confused. And I think of myself, I think of when I'm shopping for a cell phone plan. When I'm shopping for a cell phone plan, I feel very vulnerable because it's so confusing to me. All of the different elements, the equipment, the amount of data you get, is it limited, is it unlimited, and the monthly cost and the added lines, and there's so many different ways that you have to consider that in order to know what's the best deal. And at the end, I'm totally at the mercy of the salesperson. And I think mortgage is kind of like that, unfortunately. You can certainly understand the basics and essentials of it, but there's so many moving parts that I really can't emphasize enough. Find somebody you trust, and then get a written estimate. Now, because you probably, when you're shopping at the very front, you won't have made application. You probably won't get this official loan estimate, but you ought to be able, and you ought to demand that you get a written dated quote. Get a written dated quote, because that's the only way that you can compare, or a different lender can compare side by side. Here's their option, here's my option. Because it's not like you're buying a jar of Jif peanut butter, where you know what you've got and it's one thing and it's $2.50, and you go to the other store and it's $2.75. Simple decision. This is going to be very different. You'll have different fees with different names. This person will charge this fee, that person won't charge this fee, but they will charge this one. And so it's really important that you get a written estimate so you can compare side by side. You want a dated written estimate. And the assumption should be, if I were locking this loan today, what rate would I get and what would my fees be? That's what you want. And so you want a written, dated estimate. Now, the other thing that I think is really prudent to ask for, which I wouldn't be surprised if you got pushed back on this, but I think it's very prudent to ask for, is also ask for the rate sheet that corresponds to that written estimate. And I'll explain that a little bit later why, but I think that raises considerably the level of accountability. Now, again, if you're working with someone you know, like, and trust, and you know that they're going to be honest with you, maybe that's not so important. But I think it's super helpful for you to feel confident that, hey, I'm getting a real quote, that if this were the day I were locking, this is what they would give me. Because the sad reality is, it's very difficult for you to hold a lender accountable to a rate that they give you today, knowing that you're not going to be ready to lock that loan in for weeks possibly, or maybe even months. Because the market will change between now and then. When you're ready to buy, when you're ready to lock that loan, they know they have to give you something that they can deliver on. But when you're just in the very early stages, I can fudge a little bit. I can look at my rate sheet and go, at this rate today would cost X, but I can disclose it lower than that because it's very hard for you to hold me accountable. So for that reason, I'd say ask for a rate sheet, and then you can correlate the rate sheet with what they're showing you there, and you can kind of have that as an anchor and as a means of accountability for anybody that's providing quotes to you. So, here I've got items in red. Now, please pretend this is red. I had forgot to highlight those, and then I had to do it with a different highlighter. So pretend like these kind of pinkish things are red as well. This is page 1 of the loan estimate, and here you're really just confirming the basic terms. Here's the date. You want to know the date. It's a 30-year loan. It's a purchase transaction. It's a fixed rate. It's conventional. It's not an FHA. It's not a VA, USDA loan. And it's not locked. Typically, it's not going to be locked at this early stage. The sales price is $500,000. The loan amount is $475,000. Is that the right amount of down payment? Were you planning on putting $25,000 down? Here's the interest rate. And then one thing is, don't neglect also comparing mortgage insurance. Mortgage insurance can differ sometimes significantly between one lender and the next. And so just make sure you're comparing those things and you're factoring that in. The interest rate will matter more typically than the mortgage insurance, but you could conceivably have a higher interest rate and lower mortgage insurance and that be the better deal, the deal with the lower mortgage insurance. So just factor that in. Down here they have this, what's called estimated closing cost. I think that's an unfortunate label. This is the regulatory language. This is what we're required to put because it conflates two very different things. This includes $49.57 in loan costs and $44.99 in other costs. Well, these other costs are really not costs associated with getting a loan. These are costs associated with owning a home. Basically, real estate taxes are included in here, and homeowners insurance are included in here, and also prepaid interest, which we'll talk about here in a little bit, but that's interest on the loan. That's not transaction fees associated with getting a loan. So that's kind of page 1 of the loan estimate. Now pay attention to this number, 9456. Page 2 is where all the details are. So here's that 9456 right here, and it's comprised of all these details. Now I've got this detailed page, I've got this same page 3 times. And one time I've got red highlights, another time I've got yellow, and the other time I've got green. And I'll explain why here in just a minute. The red highlights are again, this is where the lender's going to make their money. These are lender fees. Yeah, so the rate we saw here was 3.008, but how many points are they charging you to get that rate? Are they charging you points, or is there a lender credit? Maybe that rate is a little above the lender's market, and they're willing to offset some of your closing costs because you took a rate above market. Or maybe that rate's a little below the lender's market and they're charging you points. And neither one is right or wrong or good or bad. It just depends on what your objectives are. But you do want to make sure that you are comparing one lender to the next. And again, this is why it's helpful to get the rate sheet. Because you can look at the rate sheet and say, okay, I see the rate of 3.008 on here. And oh yeah, I see that they are 0 points associated with that loan. So that quote you gave me has some validity to it. And or look, no, there's a 1% being charged on this rate sheet. Why isn't it showing up on my loan estimate? Or can you show me where that is on my loan estimate? So anyway, get that rate sheet. But this is also underwriting fees. Some lenders will charge underwriting and processing. Some will call it an admin fee. But these are lender fees. These are what lenders have direct control over. And so you just want to compare these and just be aware of these. Now, the processing fee as well. Many lenders some lenders will charge a processing, some won't. Sometimes this will be an in-house, sometimes it won't. But you just want to make sure that you are comparing that, including that in your comparison. Again, these are the ones that lenders typically have direct control over. And then this next is going to be yellow, the yellow fees, the yellow section. These are fees where I would say there may be some minor variation between different lenders, but it's really not going to matter that much. It is, the appraisal fee. Sometimes lenders will run special and they won't charge an appraisal. There's a credit report fee. The processing fee should have been X'd out of this yellow, sorry. And then investor, tax service fee. All of these lenders, most of these lenders are going to charge these, but you can see they're very modest, especially when you take out this processing fee out of here. And it's not going to make a big difference. Now here's the fees that you really want to pay attention to, but you pay attention to because they're differences in estimates that ultimately won't make a difference on the bottom line, when you finally get your loan. And the reason for that is all of these fees are going to be the same at the end of the day, no matter what lender you choose. But what may differ is how lenders estimate that. And that's why you got to pay attention to them. So for example, if I wanted to be aggressive and look like I was going to have the lowest cost, I could artificially estimate title and escrow to be lower than I maybe think that they really will be. And so you may have 2 different lenders and they will estimate this, maybe they're $500 difference between the title and escrow estimate. And so you'll look at the one and say, well, this guy has a $500 less in fees because their title and escrow is $500 less, when at the end of the day, your title and escrow company is negotiated as a part of the purchase and sale agreement, and their costs are going to be whatever their costs are going to be. Now, one or the other lenders may be more accurate in their estimate, and of course that matters to you, but they're not going to be a differentiator in terms of your actual final cost. And that's really what all of these green items are. The recording fees are what the county charges. So you may see differences in estimate here, but ultimately they're not going to differ depending on what rate, what lender you choose. Homeowners insurance, you're going to shop for homeowners insurance on your own, and you're going to tell your lender, this is who I'm using, this is what my premium is going to be. So we're going to estimate that for you going in, but what this final number is won't differ between 2 different lenders. Homeowners insurance, again, you're going to have to put some deposits into the escrow account, as well as real estate taxes. Real estate taxes should be pretty accurate for the most part, unless you're buying new construction. Most lenders have access to county records. They can get you for a particular property what the actual taxes should be. So you should expect that. Now, if it's new construction, typically those properties haven't been assessed yet, and so some estimation is involved there. But again, you'll see variation in terms of how people estimate that. But your county taxes, even with new construction, are going to be what they're going to be. And they're going to be the same no matter what lender you choose. And so just be aware of that. These are fees that you do want estimated accurately, and you should pay attention to that. The one thing I didn't point out here was prepaid interest. Prepaid interest is a little more complicated in that prepaid interest is the interest for your new loan for that first month that you get into that loan. And it's a technicality. Basically, when you pay a mortgage payment, you're due on the first of the month, but you're paying interest in arrears. So if you pay a payment that's due on January 1st, you're paying interest that accrued during the month of December. But what happens when you buy a loan and let's say you close on your house and you close on December 20th? Well, that lender doesn't have time to get you in their system to send you a statement and have you make a payment by January 1st. So they're going to have you skip that January, start in February, but they do want that interest for that little part of December that they gave you the loan. And that's just called prepaid interest. And where this can be gamed a little bit by people trying to look like they're the lowest cost lender is, prepaid interest, if you close on the 30th of the month, you have 1 day of prepaid interest. And so very, very small amount of prepaid interest. If you close on the 5th of the month, that's 26 days of prepaid interest, and that number can be a lot higher. And again, you're only paying interest on the actual days you have the loan, and it's not going to matter what lender you choose. Whatever lender you choose, you're going to close on a certain day, and you're going to pay that many days of prepaid interest, but that number can vary significantly. So just, if you see somebody that's just quoting 1 day, well, if you know you're closing on the 30th of the month, that's great. But if they're quoting 1 day and it's just a hypothetical way out in the future estimate, I would be a little careful with that, because that's probably an unreasonable expectation to set, and you might be unpleasantly surprised. So anyway, that's just some tips about how to shop, and thanks so much.